It's 2:17 a.m. You sit up, not because of a noise, because of that feeling, that tight, cold knot that wakes you before the alarm ever could. The kind of knot you only get when something you trusted just cracked. You grab your phone, one glance, silver, down hard. Not a gentle pullback, a shove, a dump. The rally snapped today like a dry twig under a boot, and by morning the anchors will smile and read the script. Healthy profit-taking, normal volatility, markets digest gains, lies, because this wasn't normal selling. This had teeth. This had urgency. This had the scent of somebody getting caught. You know what it looks like when a casino catches a card counter. They don't congratulate him. They don't digest gains. They turn the lights up. They call security. They change the rules mid-hand. Silver doesn't trade like a normal market. It trades like a rigged table, paper promises, leverage, derivatives stacked on derivatives, a Jenga tower built by people who never plan to be in the room when it falls. And when that tower starts to wobble, they don't let it fall slowly. They kick it, they smash the price, they shake out the weak hands, they scare the sleeping herd back into paper. Because if regular people ever see the real price of hard assets, the game ends. They can't have that. Not when debt is swallowing everything. Not when retirees are the last pool of quiet money left to harvest. So they do what they always do. They hit the button, they pull the lever, they flood the room with noise, and they count on one thing: fear. Fear makes people do stupid things. Fear makes people sell the lifeboat for a seat on the ship. And the awakened few? They're supposed to feel foolish, alone, embarrassed. That's the trick. But today wasn't just a bad day on a chart. Today was a warning flare. Because after a snap like this, next comes the forced liquidation wave. Not a theory, a pattern. Like the first crack in the Titanic's hull. You don't need to see the whole ship underwater to know what comes next. You just need to understand one ugly word: called. The system doesn't break when people get nervous. It breaks when they get called. Margin calls, liquidity calls, collateral calls. And those calls don't care about your feelings. They don't care about the story on TV. They care about math. Now here's the part they will not explain to you in plain English. Most silver buying on Wall Street isn't some guy taking delivery of real bars. It's a bet. On a screen, a contract, a promise, a paper claim. And paper claims can be stacked like poker chips. 1 ounce of real silver can have many owners on paper. Because the system isn't built on metal, it's built on confidence. Confidence is a fragile thing. It looks strong right up until it isn't. When silver rallies, leveraged money piles in, fast, greedy, like a crowd rushing into a lifeboat without checking if it floats. Hedge funds, momentum traders, options gamblers, futures speculators. They don't pay full price, they post margin, meaning they put down a little to control a lot. That's fine when price rises. They look like geniuses. They pound their chests. They tweet victory laps. But when the rally snaps, the math turns savage. Here's a picture you can see. Imagine a man buys a house with almost no money down. He's leveraged. If the house rises 10%, he's a hero. Champagne, chest out. But if the house drops 10%, he's done. Because the bank still wants its money. That's leverage. Now translate that to silver. A leveraged trader doesn't lose slowly, he loses suddenly, because the broker doesn't ask politely. The broker demands collateral, and when that collateral isn't there, positions get liquidated. Not tomorrow, now. Now watch the chain reaction. Silver falls, losses hit, margin calls go out. To meet those calls, funds sell what they can, not what they want. They dump positions, they raise cash, and when enough players do that at the same time, everything turns into a fire sale. Silver, gold, stocks, bonds, anything liquid. It spreads like a virus. And here's the dirty part. When liquidation starts, it doesn't stop at the bad bets. They sell the good ones too. They sell what's green to cover what's bleeding. So you wake up thinking, at least my blue chips are safe. Then you watch them fall. Not because the company suddenly broke, because somebody needed cash by noon. That's how contagion works. Fast, blind, mechanical. And the scariest moves often happen when you can't respond. After hours, over a weekend. When you're eating dinner and the headlines hit your phone like a punch. Imagine this. It's Sunday night, futures open, and in 10 minutes you watch a month of steady gains evaporate. Not because you did anything wrong, because leverage did what leverage always does. It pulls the floor out. That's why a silver dump isn't just about silver, it's about the plumbing, the pipes, the pressure. And when pressure spikes, something always bursts. Here's the question you need to ask yourself. If the market is so healthy, why does it need so much leverage to function? If the system is so safe, why does it melt down the moment collateral gets tight? Because it's not a free market, it's a managed market, a confidence machine. And confidence can be manufactured until it can't. Now you might be thinking, Okay, but the government will step in. You've been trained to believe that, like a child believing the lifeguard always arrives. But safety nets are thinner than people realize. Take FDIC insurance. Yes, it exists. Yes, it's real. But it has limits and it has conditions. In the US Algo stock, the headline number is up to $250,000 per depositor, per bank, per ownership category. Most retirees hear that and exhale. Then they do the worst thing possible. They go back to sleep because they confuse insured on paper with available on demand in a crisis. Those are not the same thing. Insurance is a promise, and the modern financial system is drowning in promises. Promises of pensions, promises of bond payments, promises of entitlement checks, promises of future tax revenue that won't be enough. So, here's the line nobody wants you to say out loud. When too many promises come due at once, the system doesn't pay smoothly, it delays, it restructures, it changes the rules, and it always protects itself first. Because the system isn't designed to save you, it's designed to save itself. You want proof? Look at any crisis. The public gets rules, the insiders get rescue lines, the sleeping herd gets speeches, the awakened few get prepared. Now lock in this sentence. Say it slowly. This isn't a theory. This is math. If leverage is high, volatility becomes lethal. If debt is high, interest becomes lethal. If promises exceed real assets, somebody gets sacrificed. And retirees are always the easiest target because you have what they need. Savings, time, trust, and you can't rewind the clock. Now I'm going to tell you something that will make you uncomfortable. That's the point. The next phase after a liquidation wave is not relief, it's control. When systems wobble, governments don't loosen their grip. They tighten it. They don't say, we failed. They say, you are the problem. They say, panic is dangerous. They say, misinformation is dangerous. They say, we need stability. Translation? They need obedience. And they roll out the next solution. A cleaner system, a safer system, a modern system. A system where your money is permissioned, tracked, filtered. A world where you don't truly own what you have. You just access it until you don't. That's why digital currency proposals keep showing up in policy discussions. Not because it makes your life freer, because it makes their job easier. With programmable money, rules can change fast. A limit on withdrawals, a delay on transfers, a penalty for hoarding, a temporary spending restriction, always temporary, like airport security, like emergency powers. They never leave. And you won't get a phone call warning you. You'll get a pop-up message. Due to market conditions, out of an abundance of caution, for your protection, those words are the velvet glove over the iron fist. Now future pace this, because you need to feel it in your bones. Imagine this. You're at the gas station, card in hand. Declined? You try again. Declined. The clerk shrugs and says the network is down, but your phone has service, everything else works. So you drive to your bank, the parking lot is full. People standing outside like it's a concert, only it's not music you hear. It's arguing, crying, anger. A printed sheet taped to the glass door. Temporary access limitations. Temporary. Inside, a manager with tired eyes tells you it's just until volatility settles. Then he adds the line that ends your day. Your funds are safe. Safe, like passengers on the Titanic were safe after the first iceberg report. Now picture your lifestyle, the one you earned. Groceries, medication, gas, heating bills. Imagine being told you can't buy what you want when you want because the system you didn't design is malfunctioning. And they expect you to accept it because the sleeping herd will accept it. They always do. They'll say, well, if it helps stabilize things, they'll trade freedom for a receipt. But the awakened few, they see the trap because they understand the real goal isn't stability, it's compliance. Now let's talk about the quiet word that shows up in the fine print when banks get stressed. Resolution. That word sounds boring, like an office memo, but it's a trapdoor. Resolution means the system has a plan for what happens when institutions can't meet obligations. And in that kind of moment, the rules can shift. Accounts can be limited, transfers can be slowed, certain claims can be treated differently than others. And the average person learns about it only after the fact. That's the point. They don't want a stampede, they want an orderly harvest. Now, I'm not saying tomorrow morning you wake up to a locked bank. I'm saying the incentives are moving in that direction. And when incentives move, history follows. History is not gentle. History is a hammer. It hits the unprepared first. Now connect this back to today. Silver dumped, hard. A rally snapped like a cable on a bridge. Why? Because the paper market is under stress. Because leverage is high. Because collateral is tight. Because confidence is brittle. And when a market breaks like that, it's often not the end. It's the start of forced selling. First they push the price down, then margin calls hit. Then funds sell whatever they can. Then safe portfolios start bleeding, and the public gets scared. And in that fear, they hand over more control. That's the trap. So what's the exit? Not a stock tip, not a magic trade, not some shiny app. The exit is ownership, real ownership, physical gold, physical silver. Not because they're investments, because they are survival tools, freedom tools, bearer assets. That phrase matters. Bearer asset means if you hold it, you own it. No permission required, no counterparty needed, no app, no login, no banking hours. It sits in your hand, cold, honest, silent. And it does one thing paper can't do. It doesn't need a promise to be real. Now let's talk about the invisible killer most people don't see until it's too late. Counterparty risk. That's the risk that the other side of your asset can't pay you, or won't, or is legally allowed to delay. Your pension is a promise from a system. Your annuity is a promise from a company. Your bond fund is a promise from borrowers. Your bank account is a promise from a bank. And in a forced liquidation wave, promises get tested. And the ugly truth is this. When stress hits, paper assets can turn into permission slips. Please wait. Please call this number. Please accept these terms. Please take this payout instead. But metal? Metal is final settlement. No committee required. No overnight policy meeting. No processing delay. That's why I say this. Be your own central bank. Because central banks don't store their reserves in someone else's promise. They store hard assets. They understand the rule of history. When empires wobble, gold survives. When currencies weaken, silver trades. When governments panic, citizens get trapped. And the people who didn't prepare, they learn the hard way that convenience is not the same as security. Now, important. This is not a call to panic. Panic is what they want. Panic makes you sell at the bottom. Panic makes you beg for protection. Panic makes you accept rules you'd never accept in a calm year. This is a call to think, to prepare, to stop trusting a system that has shown you repeatedly that it will protect itself first. Let me give you a simple test. If your wealth depends on a screen, a password, a company, a government, a bank, then you have a chain, and chains are fine until someone tightens them. Now, future pace, one more scene. Imagine this. A letter arrives, official seal, polite language. It tells you new reporting rules apply to certain purchases. It tells you transfers above a certain amount may be delayed for review. It tells you cash withdrawals are being managed to prevent instability. All of it framed as responsible, all of it framed as temporary. And the sleeping herd shrugs, because they assume it won't affect them until it does, until they need to move money fast, until they need to pay a bill, until their grandchild calls from the hospital. And suddenly, review feels like a cage. Now here's what hard assets do for you in that world. They remove dependencies. They reduce your need to ask permission. They reduce your exposure to promises. They give you options. Not on a screen. In real life, a small stack of silver doesn't care what a bank's policy is. A few ounces of gold doesn't need a network connection. It doesn't ask if today is a holiday. It doesn't wait for business hours. It just is. And in unstable times, just is priceless. Now, if you're still with me, you're not the herd. You're not asleep. You're paying attention. And that alone puts you ahead of most people. Because most people don't want the truth. They want comfort. They want someone to tell them it's all fine. They want the lullaby. But the lullaby ends when the math arrives. And the math is arriving. Debt doesn't disappear. It moves. It gets rolled. It gets patched. It gets hidden. Until it can't. And when it can't, the system looks for exits. And guess whose pocket is closest? Yours. So here's the question that matters. What happens next? After the smash. After the fear. After the forced liquidation wave. Do they let silver rise quietly again? Or do they use the chaos to push new controls? You already know the answer. They use it. They always use it. That's what crises are for. Now, what do you do with that knowledge? You don't argue with strangers online. You don't wait for permission. You don't trust the same people who told you inflation was transitory. You take steps that reduce risk, real risk, counterparty risk, rule change risk, access risk. You become harder to trap. And physical metal is one of the simplest ways to do that. Not the only way, but a powerful way. Because it moves part of your life savings out of their system and into your custody. Now, let me say something blunt. If all your retirement sits inside the same machine that can freeze, delay, or relabel it, then you're betting your future on their goodwill. And goodwill is not a plan. A plan is what you can hold. A plan is what you can access when others can't. A plan is a lifeboat that doesn't require a ticket. So yes, silver dumped. Today, hard. And that was the snap, the crack, the warning. Don't treat it like entertainment. Treat it like weather. When the sky turns green and the wind changes, you don't debate if a tornado exists. You get inside, you secure what matters. You protect your family, because the people who wait for the siren are the ones the siren is for. If you want to survive what's coming, subscribe to this channel. Not for jokes, not for comfort, for preparation, because this channel is for the awakened few, not the sleeping herd. And one last thought. Paper wealth feels safe, right up until the moment it doesn't. And when that moment arrives, comfort won't matter, access will, ownership will. And the people who prepared quietly will sleep, while everyone else stands at a locked door, holding a phone full of promises